All right. Okay, like I said, this is going to be recorded. One thing I say at the beginning of all these webinars, you guys, is to please review it again, especially if this strategy is new to you. If you're new to options, first time through, it'll kind of run right through you, and the next time through, it'll kind of stick to your long-term memory, if you will. So try and review it one more time afterwards, shortly thereafter, and it'll help it stick in. Anyway, so this is another options workshop. This is going to be a strategy to use with a bullish assumption, and it's actually really great to use right after an earnings season because we get the volatility to come out. There's not a whole lot of things to do out there with selling premiums, so this kind of gets us geared up for earnings season, if you will. And I'm going to go in through the rules of how to set this up so it'll increase your probabilities of success for the most part. Anyway, let me go over a couple of things real quick. My name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading in college with a psychology degree with some money I had earned, and decided to switch it over to finance. And after graduating college with a finance degree, I moved up to Chicago to work at the Board of Trade. So in that time, from college to the floor to now, I've been trading for well over 20 years with my own money, and I've traded in all market conditions basically throughout that time. I've traded everything from stocks, financial futures, commodities, currencies, options, and options on all of these products in all market conditions. We've got to go over this disclaimer. This is any opinions, news, research, and analysis or other information provided by ProTrader Strategies, associate companies, or employees is provided as general commentary. It does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. The reason why we can't do that, you guys, is because we don't know your risk parameters. We don't know what's in your portfolios, and what we're talking about could be counterintuitive to what you're already doing. So you need to take this information, you guys, play around with it, and implement it into your portfolio in your own way. Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, so this one's going to be on the call diagonal spread. Many of you probably have heard how to do the diagonal or traded diagonals. I'm going to talk to you about different ways to set this call diagonal up to increase your probability of success. And like I said, one of the best times to implement this strategy is right after an earnings season, because there's a lot of low volatility going on. There's a binary event will increase that volatility, and we're going to try and take advantage of that as well. All right, to set it up, we're going to be selling an out-of-the-money call in the near-term expiration cycle, and then we're going to be buying an in-the-money call in the further expiration cycle. So with this, you know, a lot of people will set it up where they talk about the buying the in-the-money first. As a floor trader, we always kind of set this up from the nearer term and then went out to the further expiration cycle. And the reason why is because we're going to try and pay for some of that, or at least most, if not all of that extrinsic value, which is what's going to decay around those options. Remember, there's intrinsic value within the money options, and there's extrinsic value. In the money options, intrinsic value is what makes that option equivalent to the price where the underlying is trading. And I'll go into all that. The rest of the extrinsic value is what will decay throughout time going into that final days of expiration. It's what the real option is worth without the theta decay. Like I mentioned, this is going to be a neutral to bullish assumption. Now, the reason why we want this to be somewhat neutral in the beginning is we don't want it to really rally really hard and have expansion and volatility happen right away. We want to be able to have this slowly kind of trickle up, if you will, just a slow, steady upward momentum with this particular strategy. All right, so picking the right strikes. These are my steps, the essentials to success on this strategy. And picking the right strikes has to do with which in-the-money option we're going to be buying and how we're going to pay for that. So it's not just buying an in-the-money option and selling one against it, because you can actually set this strategy up for failure. A lot of people don't talk about how to set it up to where you have the premiums offset each other on the extrinsic value side. And if you don't finance enough of that extrinsic value, you could be paying a debit in some situations where you're paying more of a debit than the width of the spread even, which means that you can't possibly win. If you're paying $5 for a $2.50 wide spread, you're set up for failure. Now that's an extreme example. You probably won't ever see it that big, but you could have a $5 wide spread and be paying like $5.03. So you're paying over the width of the stripes or the width of those spreads, then you're going to automatically lose right away. So setting that up, picking the right strikes is going to be incredibly important. And one of the easiest way to do that is to finance that extrinsic value. If you're looking at it where the one that you're selling has to pay for the extrinsic value of the one that is in the money that you're buying, then that will set you up for success right away. It'll also allow you to be buying this underlying synthetically under market value. Picking the right duration. So we kind of want to make sure that the one that we are buying is either in the expiration cycle, which is the perfect scenario, and the one we're selling isn't, or sorry, the one that we're buying is in the earnings cycle, and the one that we're selling has no event in there. So in that regard, we would never want to set this strategy up where we were selling a call during or going into an earnings event. Does that make sense? The one we're selling, we want to make sure is a pretty clean month. All right, and in that regard, when I'm talking about theta decay and things of that nature, the one that we're selling, we want it to be, sorry about that, are you guys still able to see my screen? The one that we're selling is going to be within this cycle here because we want that one that we're selling to decay rather quickly. The one we're buying, we want it to hold off on that theta decay. We want to hold on to as much value in that one we're long for as long as possible. And the one we're selling, we want to decay as quickly as possible. So we're going to be trying to sell in here and buy out here. And we're going to be trying to, this one is really important. The right environment for this one is a low implied volatility or a low vega type environment. We also don't want the volatility between those 2 months to be very different. We want it to be within 2-3 percentage points, and I'll go through that when we pull up the platform, but we want those to be pretty tight. The reason why is because further out in time, especially that one that we're buying, is going to have a binary event in it, hopefully, and that will increase volatility. So we want to make sure that those are relatively tight because we don't want that to skew if volatility goes down. If volatility goes down, that one we're buying is going to get hurt if it has too much volatility in it. And then picking the right underlying, we want to have something where there's a lot of participation, you guys, because when the market starts getting wanky and things start getting awry, we want to have a lot of people in that market to facilitate trade. If you're trading in a market where there's not very many people in there, when the going gets tough, people are going to flee that one and go to the one with the most liquidity to adjust their positions. And those markets will actually get quite a bit wider. They'll probably even double. So if you're playing in an option that has, 25, 50 cent wide bid ask. When the going gets tough or volatility starts going up, those bid asks will get further and further away because people realize the risk and aren't going to give up as much of an edge. Whereas when you're in one where there's a lot of participation, there's always somebody willing to give up a little bit of edge in order to get filled. So that's what we want to take advantage of going forward. So make sure there's a tight bid ask. One of the things as a rule of thumb is about, if it's a $100 stock, if you basically put the decimal in front of whatever the underlying is trading, so $100, you put the decimal point right in front of that $100, it should be at least inside of 10 cents wide. So a $300 stock should have about inside of 30 cents wide. And you'll see a lot of them are even tighter than that, especially the ones where there's a lot of participation in, and that's what we want to see. So anything under $100, inside of 10 cents, and then when you go incrementally higher from there, just kind of stick that decimal point, move it 3 ticks to the left. So if it's $300, you're moving it 3 ticks to the left, 30 cents. If it's a $1,500 stock, you move it 3 ticks to the left, and it's $1.50, right? So think about it that way. That's where your mind should be on how wide those bid asks should be as a rule of thumb. All right, so know your exit strategy before entering the trade. So what we're going to be looking at on this, so for instance, we're going to be looking at paying no more than about 75% of the width of the strikes. We're going to need a calculator for that. So whatever's left, we're going to take, that's our max profit, whatever would be left from that. So if it was $10 wide, we paid $7.50 for that strategy. $2.50 is our max profit on this strategy. So we're going to be trying to take somewhere around 50% of that, because we don't want to go into expiration. As a floor trader, we were really wrapped around this whole idea. We really didn't want to have the risk going into expiration, because there's gamma risk. The gamma is going to affect your premiums. There's a lot of other things that go on. Going into expiration, a lot of hedge funds will try and pin prices and move that market in their direction, and that can happen quite violently, especially towards expiration. So we want to be out of that whole game way before that. Max profit on this, like I mentioned earlier, it's going to be the width of the strikes minus that net debit we paid. So I kind of gave that example already. If we had $10 wide width strikes minus that $7.50 we paid for it, $2.50 is our max profit. Some people will take this where they let that short call expire worthless and take that long call all the way through, and then in that regard you actually have unlimited profit potential, because it could go to the moon right after that short call expires. So you can take advantage of that. So I'm generally not taking this risk that far unless the strategy isn't working out for me and I let the short call expire worthless. I might even try and roll it out in time, collect a little bit more credit, lower what I paid for this call overall, and lower my break even more. But at the beginning, the onset of this, the max profit is the width of the strike minus that net debit we originally paid. And your max loss, anytime you guys pay a debit for any option or any option strategy, the max loss you can lose is that debit paid. So that's the nice point about having paid a debit, but at the end of the day, you know exactly what your max loss is, which is very reassuring. And then the break even is going to be that long strike and that further duration, that one we buy that's in the money. Our break even is going to be that long call plus the net debit paid. And we're going to try and make this where our break even is actually below where the underlying is trading. That's going to be our goal in all of these. The last thing we want to do is have our break even $1 above where the underlying is trading. That's just setting yourself up originally for disappointment and a loss. So try and set that up where we're going to be having our break even slightly below or where we are currently seeing the underlying trade. And volatility can affect where our break even is by if it increases or decreases as we go there, depending on which option cycle sees that increase in volatility. How close to earnings would you buy the short options? Well, we're going to try and have these short options not in a cycle where there is earnings, which is why I said this is perfect for it, because there are very few there are very few underlyings that still have earnings, so we're going to have a lot of possibilities. But the nice thing is we're far enough down the road where that one that we are actually buying is going to be in the earnings cycle. So the earnings should not affect our short calls in this strategy, because the volatility isn't going to affect that expiration cycle, because the binary event happens after expiration. So the volatility will expand after. Does that make sense? So essentially you want to strangle the earnings date. I don't know if I'd call it strangling it, but I mean, what we essentially want to do is get our option for its real value in that earnings cycle, because if we can do this in low volatility, that earnings cycle, as the closer we get to it, that call that we're long should benefit from the expansion in volatility. Does that make sense? All right, oops. So let's get to the platform here, and I'll pull this up. And this is usually at the time where I throw it out for you guys. Give me some stocks that you guys like to trade, throw out the tickers in there, and we'll run through the rules here as we go. And I'll show you in the platform my steps to go through this. Perfect. I'm getting a lot of them going on. Short expiration before earnings, long expiring right after earnings date. Yes, absolutely. That's exactly right. We're getting short right before the earnings. We're getting long in the earnings. All right, so a lot of people, yes, and we can do ETFs. So, but we want, when I'm saying low implied volatility, we want something that's like below 30. So Dow Jones is not going to have that, but we'll go through a couple of the ones that people are throwing out there already. So there's TSO. So then we go into it's got low implied volatility, so that we got that going for us. And the way we can find out, so I'm going to, like I said, 35 days or closest to, there's not enough time in December. There's not going to be very much premium in those. So I'm going to stay away from those. I'm going to be trying to hit somewhere between that 45 and 35 days, because that's where we saw on that slope we really start seeing theta decay. The next thing to look at is it's an $84 stock. We got 20 cents wide, 15 cents wide, so that really wouldn't necessarily meet my rules on the inside of 10 cents. That's pretty close. Maybe you might know this stock a little bit better than I do, and it may very well have tighter bid ask during the day. The other thing you can check is the volume and open interest. Not a whole lot of participation in there today. They do have pretty decent open interest, I suppose, but we'll look at it just for the sake of the argument. You were the first one at it, so we'll look at that. So the thing I'm going to look to do is sell my first option, somewhere around the 30 delta is what I like to do. It gives me a little bit of room to the upside. It's going to give me about $6 to the upside. So I'm going to start out with trying to sell the 30 delta. So first thing we do is sell the 90 calls there in the first one. So now I know what this is all extrinsic value. This is what I was talking about, extrinsic value. Out of the money options always have all extrinsic value. Now, what we can do is look to buy an option and finance the extrinsic value. And like I mentioned, the puts, these are all extrinsic value. Well, that's actually very close to the amount of extrinsic value that's embedded into this underlying here. So if we've financed, if we're selling it for $1.77, it's probably going to be closer to about $1.80 something. We can buy this one that's in the money, the 75 calls, because that's going to easily finance the extrinsic value of this option. So hold down Control and add that in there. So a couple of things to look at. We have $15 wide, right? So we got a $15 wide strikes. So we need to figure out if that's within 75%, those width of the strikes. So $9.86 divided by $15, 67. So that's inside there. That's a really good bid ask for that. So that would fit those rules. The next thing we want to look at is adding this $9.86 to the 75, and that gets us up to 84.86, right? So 84.86 is below where the last has been trading. So that puts our break even slightly below where the underlying is currently trading. Great question, JQ. Chance of being assigned on this, on the short call. If this immediately goes against us and immediately rallies up, yes. If you take this into expiration or let it go really deep in the money, you do have the assignment risk. At that point, though, you are most likely going to be close to our profit target on this one. So that I would have closed it, right? One thing, people have a tendency to worry about getting too close to the market on this. And having those short calls go in the money and it maybe start to lose money. Keep in mind the options that are out of the money or closest to at the money. This delta, for every dollar increase in the underlying, this delta adds into here, okay? So that's going to increase this strike by 31 cents for every dollar. The next dollar is going to be different. It's going to increase by 35 cents because you add in the gamma to it, but the first dollar is 31 cents. But the further this goes closer to the at the money, you know, you can see it increases by 51 cents. But remember, this one that you bought that's deeper in the money is also going to increase. So for every dollar increase, we could subtract the 78 from the 31 and realize that we're going to be gaining almost 45 cents for every dollar increase. So it's going to be offset by this one increasing more than the one that we're short is increasing. Does that make sense? Okay. Do you hold the long after earnings? Trevor, a lot of times that's going to depend. If I've financed enough of it and it's working out pretty good, I will usually close it. If it's not been working out, then and I've lost money on it going into that earnings event, that's probably when I'm going to risk more of it, right? If I have a winner heading into that event, I'm not going to risk that money anymore. If it's afterwards and I'm losing money, or if it's heading into that and I've been losing money on it, I'll probably roll the dice on it more. But I'm never gonna risk good money going into that earnings event if it's been profitable. If it's been a loser and I have really nothing else to lose, then that's when I'm going to look at letting it roll. Does that make sense? James Prescott, AZ. Oh, Prescott, Arizona. All right. It's cold in Arizona these days. So anyway, so that one would work out, other than the fact that you may know this stock a little bit better than I do, how easy it is to get in and out of these. To me, it doesn't look like it's going to be that easy, just at first blush. All right, so the next one was SPX. Somebody likes going with the big dog. All right, so we're going to be looking at the 48 days. So it's basically going to be the Jan Feb. And if it doesn't have the Feb, you're going to have to basically wait for the December to come off in order to do that, because I don't like to really buy it that far out there. But what's your exit profit target? It's going to be somewhere around 50% of what my max profit is. So if it's $10 wide, so in that last example, it was $15 wide. We were collecting $10, or we were paying, let's say, $10. So $5 is my max profit. I'd probably be looking to close that around $2.50, something like that. If I was winning by $2.50. Because otherwise you're going to have to ride that out into the end of the day, and there's just too much risk in there, and it's just not worth it, you guys. Then just because there's so many ancillary things going on, the closer you get to expiration, that's why you need to cover early. How many strikes away from the at the money would you sell the short puts? Or you mean the short calls? Usually the ones that I'm selling in the calls are going to be around the 30 delta is usually where I start out with. So something with like SPY, we're going to have, we're going to be able to get it further away, but we're also going to be paying a lot for this. So let's just go 30 strikes away. Usually gets us to the 30 delta. So I'm going to be looking at something like the 36 delta, something like that. This is about a half a standard deviation away. So, you know, this is what I was talking about. So with something that's a $2,000 stock, you move it 3 ticks to the left, we get $2.20 wide. Would be our extreme on that of what we would want, and you can see we're well within $2.20 on these. And if you look at the volume and open interest, you can see that there has been plenty of volume and a ton of open interest. And it is SPX for that matter. So, so we're going to be looking at selling this strike, because I'm going to go about a half a standard deviation away. So selling the, what is it, the 22.25s. So now I'm going to look to pay for my extrinsic value with $21 or something, $20.75. So $20.75, I've got to go to these. I'm going to be going even further away. Let's just do all just to save time, not guessing. So $20.70. So I'm basically just scanning the puts to find where it starts coming in close to $20, because that's where I know the extrinsic value of these options are. So $20, it's going to be somewhere right in here. It's going to be pretty close to a pick 'em. I'm going to go to the safe side and buy these then, because now I know that my calls I sold will at least pay for these 20.45s. Now, of course, this is, if you have a really big portfolio, you know, this is going to be a big trade. So keep that in mind. And it probably won't have a ton of volatility happening in it if the market goes up. If the market goes down, you know, the diagonal call diagonal for this one would work out quite nicely, because then you'd get the expansion and volatility in that back month. All right, so we can look at the width of the strikes here. So we've got 55 and 25, so 80, so 180 ticks wide. I did that math right in my head, didn't I? It's 180 ticks wide. Yeah. All right, so so we got 180 ticks wide. So we take the 140 to 80, divide that by the 180 ticks wide spread, and it's 79. So you're risking a lot to make very little on this one. Okay. What would hurt the call diagonal? If volatility really started coming out of it. And it's going to hurt any diagonal. If volatility, that's why you want to start out with a lower volatility, because the probabilities of expansion in volatility is greater than it going down. So the lower the implied volatility when we get into this trade, the better. So keep that in mind. Volatility contracting rapidly will hurt this strategy right away. One thing I forgot to mention on this is what I was talking about. You want pretty close to, you want your volatility to be pretty close. So the one that we're actually trading is these JANs. So the JANs have 14, let's call it 15% implied volatility. These are 16%. So we want that within 2 or 3. 3 on the max. Under 2 is best case scenario. So we're basically very close to just over 1% difference between those two cycles. And the reason why you don't want you wouldn't want this to be like 20 or something like that, because if volatility starts coming out, this is where it's going to hurt you, and that's the one you bought. Okay. You want low volatility in the front and in the back. All right. All right. So what were some of the other ones? We've gotten a lot of questions. So let's look at GE. All right. So these are the 2 expiration cycles we're going to be looking for. Let me close this out. I don't know why. So GE. So the first thing we want to look at between these two, they're inside of 2, so that's good. It's got low implied volatility. That's good. That meets that criteria. It's inside of that 10 cents. They're only like 4 cents wide, so that's good. 35 delta is going to be right here. We're going to have to look at these and see, because I usually like to go at least 1 tick out of the money. Oops, scroll down. So 14 cents is going to be pretty deep in the money, so we'll do that. So let's look at selling the 33s and buying ones that are in the money here. Ooh, it's pretty wide. I don't know if we're going to be able to finance it. Buying those, 6 cents, so 27. Oops. Sorry about that, guys. I don't want that. Let me do that again. I was looking for extrinsic value and bought the puts. I didn't want to do that. So I want to buy the 27 calls. So 27 and 423, so that gives us 31.27. That puts us below where the last change is, so we have sufficiently paid for our extrinsic value with this one. Next thing to look at is it's $5 wide. Right? Oh, sorry, $6 wide. So $4.27 divided by the $6 wide strikes gives us 71. So that puts that in the right criteria. And the reason why it'll work out more is when these volatilities are very close to each other, that has a tendency to allow it to happen more easily. So one thing I would want to look at is GE. The earnings come in on the 20th. So the problem is with GE though, is it lands on our short strike expiration date. So one of the issues with this is we're going to see volatility expand in this Jan more rapidly than we will in our Feb, which is the one we're long. So we don't want volatility to expand here than when we see it in our, so it expires on the earnings come out on the 20th. So that's not very good. It probably comes out in the morning too, I think. Yeah, before the market opens. So that would totally destroy that strategy. So make sure you check on it. With the, unfortunately with simulated, it doesn't show the earnings cycle, but I can see comes out right on the 20th. So we wouldn't want to do that one. Even though all the other criteria work, the major thing is not to have earnings within this section, because that's where we're selling. We want the earnings to land here somewhere. Okay? So that would be the catalyst to kick that one to the door, because we're going to see expansion and volatility there. So that would be a no. All right. So who else had some? Goldman Sachs. I like the financials in the sense that if they start raising interest rates, that these guys are going to perform very well. But I think that it's pretty much priced in already. So I don't know if I would really want to do a bullish strategy with this. It would be up to you. I would probably go away from it. There has been a big sector rotation. I don't know if you guys have noticed that, like the NASDAQ has been selling off while the Dow Jones, the Russell have all been rallying. It's basically been a rotation out of tech and into like the small caps and the blue chips. So in that regard, I'd kind of be looking at something maybe that's gotten beat up in the NASDAQ for this strategy. I don't like buying stuff when we're at all-time highs. So I'd like to see something that maybe has come off a little bit. You know, the energy sector's not done too well, but now that OPEC says that they are going to implement sanctions and curb some of the production, you know, the guys here in the United States and other oil places are going to, or other oil companies are going to do rather well. You know, we're going to start fracking again. The rig counts are going to start going up, so we could see a lot of that. Oh, sorry, I'm probably missing a lot of questions here. Okay, so Bobby, you love the big ones. All right, so let's look at Amazon. And Dave, I see your question. I'm going to have to try and digest that for a minute. I can't get my head around it right now. So maybe right after I get done with this, I'll try and talk about that. All right. Earnings are both in January. Great. Okay, good. So we'll look at the trade page. Probably going to have to use all. Try and get to the 30 delta. So I know we want here. I'll do like 30. Actually, I'll do like 50. Okay. So another one, like I said, move at 3 ticks. They should be 75 cents. Usually, Amazon has so much participation in there. It's one that will usually have pretty close to a 70-cent bid ask inside here. Maybe it's closer to $1, but there's enough where you aren't going to have to give up a ton of edge to get in and out of this one. So, so looking at the 36 delta-ish, so it'd be a pick 'em between these two. I'd probably default to the just outside the 790. So let's sell that one, and then look at the oh, they don't have the oh, so that's, sorry, I missed the Jan. So I want to go to the Jan and sell the 35-ish. So 13. So we need to try and finance about $14. So just scan over here, 14, that's not going to cut it. So this is the one we need to go to, because then it finances our extrinsic value. That's the one we're going to buy, so control and buy. All right, so the next step we're going to do is look at the width of those. So we've got 110 ticks wide. So our strikes are 110 wide, and we're paying $81. So we go 81 divided by 110 and 73. So that puts us lockstep with that. One thing I forgot to check that we should check, it's, Bobby, this is a little bit wide for me, so I'd be a little nervous. Maybe put that on the short docket, but that's quite wide for this strategy. Even though volatility should come in, that's a little too wide. There's too much of a discrepancy there for Amazon, so that probably kicked that one to the curb. Google. Let's look at Google real quick and see what they've got. So Google's Jan to here, it's 3, so that would be on the extreme outer banks of being able to let this fit within the rules. But I'll give it to you, Bobby. We'll look at it. All right, so then in the February, we got to finance $10 and around 80 cents. So I'm going to default to the one just inside to make sure, because I want to make sure that where I'm getting this call is just its intrinsic value, what it's worth. You know, that allows us to buy this from, gives us a little wiggle room if the market goes down a little bit. So hello, Andreas. Thanks for the shout out. So that's going to allow us to get inside of that. Oh my gosh, I got to tickle. Let me get a drink of water real quick. All right. So so we are adding $66 into here, so that my brain's starting to go to mush already. So I'm just going to add it with this plus the $66. So 551 minus a nickel. It's a little higher than where we really want to be. You know, it's 50 cents, but I mean, Google does move in increments of 50 cents sometimes, so that might work out. But that's breaking a couple of rules. I'd probably put this on the short list and see if we can find anything else. But at this point, you know, check these all out, write them down, put them on the short list, and if you can't find anything better, then that's what we'll kind of look at. Especially, and I would actually, and weigh your benefits and everything else. I mean, I like Google. Google always has a tendency to go up, except for as of recently, and it might be a very good time to put that in. So, you know, after earnings, they have a tendency to come off a little bit, and that's what they've done, and then they rally into earnings, which is what you want to see with this strategy. So, you know, all of those things, if you really know Google and its tendencies to do stuff like that, as you can see after earnings, it always has a tendency to come off and then rally right into them. After earnings comes off, and then rallies into earnings. You know, after the earnings, it kind of came off again. So it has a tendency to do that. So this could be a great place to do that strategy. Does that make sense? All right, so we're running close to time. So I'll do a couple that I vetted also that seem to work out pretty good. And kind of would fit my portfolio, I guess, if you will. So and in my theory, so if we think that these guys, let's say, are going to do better going forward due to things that are going on in the economy, like ConocoPhillips with OPEC, even though it's kind of at one of the highs. I did look at like EA Sports, what was it, Adobe, Microsoft, stuff like that. So those didn't fit all of the rules. So this one has it except for the charting aspect of it. How do you manage a trade after you have it on? Thanks. So here, I'll talk about a couple of those right now. So what I'm going to be looking at with the ConocoPhillips one is probably selling one that's closest to around that half a standard deviation away, right around that 36 delta. So these bid-asks have gotten wide. Usually, you know, since it's a Friday, these do have a tendency to get wider, especially after the close. People cancel all their orders, don't leave them in there, and it gets a little wider. But you can rest assured it's pretty sure that it's going to be able to do it, because when I was looking at it, I was able to finance it with this 44s. So these are going to be we're going to buy the 44 straight. And so we've got $6 wide strikes. I closed out my, let me find my calculator. So we've got one thing to check. This is within 2 away, inside of 2 percentage points. So that fits that rule. Generally speaking, these are inside of 10 cents, which we'll assume is fitting that rule. So $6 wide and $4.11. So we take the $4.11 divided by the 6, 68% the width of the strikes. So that's good. That fits that rule. In this one, it's $6 wide. Our max profit on this is going to be $1.89, right? Because we take the $6 wide minus what we're paying for it, gives us our max profit of $1.89, and then basically 50% of that right around there. So try and collect about $1 for that. The reason why, it's just not going to decay. You're just not going to get that full boat unless all the stars align, and basically this rallies up to $49.99 at expiration. You collect all that premium, you've gotten all of this. That's going to be one of the few ways that you're going to get it. You get the expansion and volatility out here. So there's a lot of things that has to happen in order to achieve that full premium. And anytime I'm looking to take a percent of profit, on the floor it was like any profit, and since the floor, you know, try to come up with ways to figure out how much profit we're going to be able to achieve before having to take it into the expiration, which is not what I want to have to do. All right, that answer your question, John? How do you scan for diagonal type of stocks? Good question. Or good stocks that would be good for this strategy. What I do is I start at the very bottom, and I put the implied volatility percent over here because that's the most important thing in my eyes with options trading, because volatility affects everything. The higher volatility allows you to get further away from the market. The lower volatility pushes you in tighter to the market. So, and that's kind of what I want with this strategy, because if there's lower implied volatility, I can finance it. I'm getting a little close here, but it also allows me to pay a little less over here on these. So that's, and I'm a little closer. So I'm a little closer to where the market is trading. Because if the extrinsic value over here was like $2, I would have to go really deep in the money, and you're having to risk a lot more. So this allows us to get closer to where the market is and risk less than what it would be if we had high implied volatility. All right, so here I'll do this also to look at the analyze the trade. Let's take that one off. It's in there from before. So this is our risk analysis. So you can see that you know what your risk is getting into it. It's $4.11, or on one lot, $411. And then to our upside, it is going to be, you know, $1.89 going across. So that's what the diagram looks like, and you can see the slopes a little funky there, but you know, this would have to be a perfect scenario where you just get it to go rather quickly, but or have it rally and pin short of the 50 strike to get your max profit there. So anyway, so on to the charts. Actually, let's go back to that. So that's that one's like a really good setup for that one. Can we do puts also? Absolutely. We're going to be doing this one on the puts next week, so I'll go through that one. IV% : I tried but didn't manage. Thank you. I'm not sure. Did you try to do it over here on the side? If you go in here to the gearbox and type in implied volatility, there should be a section, a selection for it. I also have something on setting up everything from my charts to everything else. So you can look at that to find out how to do it exactly. What would I do if the price gaps above the short strike? Well, you don't want it to happen right away, because I would probably look to close it for one, but remember, you're just not going to be able to achieve that max profit anytime soon. You probably would be able to do it close to a scratch or maybe a couple of pennies. If it gaps above right away, I'm probably looking to cover that, pull the ripcord and get out rather quickly. But remember, you know, this one's going to hurt you by increasing 38 cents, but the one that is deeper in the money is going to increase more. But, you know, obviously the deeper in the money this one goes, it's going to start catching up to this one. So that's where the issue happens, is when this gaps rather quickly, it ends up getting a higher delta faster in the money than these do. As you can see, like just as a correlation, these 44s are a 73 delta, and these 44s are a 77 delta. So if it gaps that fast, super fast, then this is actually going to start hurting you before this does. The deltas are going to start catching up with one another in a sense. Do you use spreads to day trade? I don't usually. I usually use the I usually day trade on the futures. And I don't really talk about that in my daily market commentaries, because this is more option centric. That the futures is more to just keep me in the market. Oh, you don't have this in your toss? The implied volatility percent? You should call them up, because you should have that. You should have that. And they can give you, they can always give you a script for it if it's for some reason not in your toss. I don't know why it wouldn't be, but you can call them up and they'll text you the script and show you how to punch it in there. Do ETFs work as well for the diagonals as individual stocks? Yes, they do. You can do this with ETFs also. Tell them Wolfman told Andreas. Tell them Wolfman called. I got a couple buddies on that desk. Just tell them I told you to call up and give them the implied volatility. All right. So is there any more questions? So this one, you know, this one's really good. You know, if you can get inside of even 70% the width of the strikes, you know, you're paying less and your profitability is much better. Does anybody else have any more questions? I think I got everybody's questions so far. Yes. D, this is being recorded. And one thing I say, if this is new to you, I know a lot of people have questions and have kind of, some of this has blown by you, I'm sure. Go back, watch it again, you guys. I can't emphasize that enough, because it will make this stick into your long-term memory. If this goes down, do you adjust? Yes. If this goes down, I will adjust, because if this goes down and starts hurting me, I'm going to start rolling these short calls down. As you can see, if it went down, your short calls are going to start being worth very little. So I would start rolling these down and collect more premium. Absolutely. I probably would not roll it down to invert it, and I would just try and roll down, maybe collect another dollar or something like that. And by inverting, I wouldn't want to go sell below the 44s, because now you've really locked in a loss. At that point, I would try and just sell, collect a little bit more credit, let those calls expire, and then ride that into the sunset. Does that make sense? Cool. All right. Yeah, Dave, I'll get to your question here in a second. Let me wrap a couple of things up real quick. Anyway, this is going to be this is your offer right now, and for $36, you can't beat it. I mean, I don't even know if that pays for everything that it's cost us to put all of this together and everything else, all of the man hours and everything else. So you're getting it for below cost if you take advantage of this, for one. If you guys want to learn how to trade like we did on the floor, this is absolutely the course you need to do. Shows how to set up my options screen. Andreas, I go through that in this class here. If you found up or how to do that, how to use delta to measure your probabilities of success, everything. This is what professional traders use on a daily basis, and you need to know this like the back of your hand, you guys. So watch these over and over again. I even go into the history of options. I talked about Thales from Miletus, and how he was the first person to implement options before they even called them options. So this course is designed to help produce consistent winners using all of these different techniques. So if you trade like this, it's all about probabilities. If you've heard about people playing the probabilities, that's exactly what this is about. Don't just throw darts at the board and buy options when you think that buy a call when you think the market's going to go up, because you could be doing it in a high implied volatility environment, and if that implied volatility comes out, you can be directionally right and still lose money. And that's the worst thing that can ever happen. There's a link. Good question. There's a link in the chat box for this, you guys. So you can click on this link and easily get to that. And with $36, I mean, you guys are paying more in commissions in a day probably than what this is calling. It'll pay for itself, setting you up for earnings season alone. And one other thing with this that's not listed on here, with this, you guys can reach me out, and you guys have been doing a great job reaching out to me with your questions lately. So you guys, I have a no inbox policy on my email. So if you guys reach out with a question, I'm going to get back with you with an answer. And if I can't do it in an email, I'll reach out to you on the phone and we'll talk it through. So that, and we also do the daily market commentaries where I talk about all my strategies that I'm putting on and how I defend them, when I'm defending them, and when I'm covering them, how I'm covering them, and why I put them on, and what I'm seeing even in the economic picture with the geopolitical picture and everything else. I talk about all those things, run over all the economic indicators and everything else in those daily market commentaries. They're only about 10 minutes long, but I go through the economic indicators, go through the markets, and then go through my trades and why I'm doing them and when I've done them. Is this on DVD disc or only online? Good question. It's only online at this point right now. What's the difference between a diagonal spread and a debit spread? A regular debit spread, Trevor, would be within the same. This is a debit spread, but I think what you're saying, what would be the difference between a called debit spread and a called diagonal debit spread? The difference is the diagonal is different expirations and different strikes as well. This video for this strategy only or all your strategies? A lot of these things are implemented and I talk about in a lot of the different webinars. but some of the webinars we've done are not necessarily, there you go. I think you've been taken care of on that one. The other thing is, you guys, with the Fed more and more likely to increase interest rates, this video here in particular will definitely pay for that. As a matter of fact, now I'm thinking about it, because people have like over probably 50%, some 50% or more or less, somewhere around there, in treasuries. And if they start jacking up rates, the face value, well, I mean, the value of those, not the face value, but the value of those bonds are going to go down as interest rates increase. And it's not going to, the increase in interest rate is not going to offset that loss. So I talk about how you can staff that problem off by trading options around it, and trading around dividends and stuff like that. So this is a great course, you guys, especially for the $36. It's I can't beat it, and it's in the chat window. You can reach out to us at 310-598-6677, or you can email us at trading@protraderstrategies.com. This is that link. So if you're watching over it again, you decide to do this at a later date, how to trade like the Wolfman, you can just pause the video and write that down, go to that link, and take advantage of it. All right, for participating in this. All right, I want to thank you guys all, and reach out to us also if you have a webinar. And that's why we decided to do the diagonal. Somebody was asking about the diagonal. So later webinars, we'll be drilling out on option components, how to trade options, trades I find, when and where I find them appropriate. But you can also reach out to us if you don't see a webinar out there that we've covered a particular option strategy. Let us know, and I'll look into it and try and work that out for you. You can click on that and take care of that. All right, that's all I got. I hope you guys all have a great weekend. And if you can't take that, take it easy. Thank you, guys. Thanks for your kind words. All right, now, where was, I think it was that question, Bruce. I think I've lost your question again. Or Dave Bruss. All right. Impacts of different expiration time frames: 2 to 1, 2.5 to 1, and 3 to 1. Not really sure what you're asking there. Rather, are you asking on a ratio spread? So selling, for instance, selling 2 calls to finance the 1 long call that you're doing? Or a 2.5 to 1. So selling 2, if you did it 5 to 2 or something like that, or 3 to 1. Is that what your question is? Let's see. Do you ever set up a diagonal in order to roll the short strike intentionally? I don't ever do it really to set it up intentionally, but if it's not working, I will roll that out. So it's great to have the weeklies to take advantage of that. So I will, especially if it's not working out, I will roll that short call into the weeklies. And it's best if you can roll it up and out, right? If you can roll it to a higher strike, don't just always default to the same strike, but if you can roll it out in time and higher in strike, that's the best case scenario. Because then you've paid a little bit more of, now you're paying for the intrinsic value of that long call, and you've increased the width of your spread, and ultimately that's, that exponentially increases your max profit. Did I answer your question on that, Dave? I do these diagonals every once in a while on a ratio and stuff like that, and I've done a webinar on those ratios. Because it is nice, because you can get, whenever you're increasing your risk, especially on those ratios, you also increase your probabilities and your reward. So anytime you can increase your risk, you're increasing the probabilities of success and your possibility for reward. All right, guys, I hope I answered everybody's questions. If I didn't, or if you guys have other questions that come up later, reach out to me at trading@protraderstrategies.com and I'll get back with you for sure. Can you use weeklies instead of monthlies for the shorter term? Trevor, you can. I don't usually, but you know, just make sure it sets up with the same rules, especially in weeklies. You know, the bid ask could get a little wider, and make sure it still fits within the parameters of those rules that I set up. All right, guys, thanks for participating, and have a great weekend. Oh, you got to call and miss this? It was recorded late, yes. All right. Yes, and have it sink in. Thanks, Dave. All right, take care, you guys. Have a great weekend.